Good morning. I'm Andrew Zezas, and this is CFO IntellStats Index Kickoff and 2026 Economic Outlook, and it's hosted by Real Estate Strategies Corporation and CFO Intelligence. Welcome. I'm so glad you could join us today. Today's discussion is the first in a quarterly webinar series that we'll present on CFO IntellStats, the business sentiments shared with us by CFOs and other senior finance executives. Now watch your inbox for invitations to attend future events. During today's discussion, please post your questions in the chat room and we'll address them during the session. As some of you know, I have the pleasure of serving as publisher of CFO Intelligence Magazine, host of CFOIQ.com, host of the new podcast To the Point with Andrew Zezas, and chief strategist and CEO at Real Estate Strategies Corporation. In doing so, I get to advise CFOs across North America on numerous business, real estate, and career topics. Today, I'm joined by my colleague, Marty Daks. Marty's editor of CFO Intelligence Magazine and CFO IntellStats Index. I'm also joined by our guest expert, Ryan Severino, who'll join us later on. Ryan is Managing Director, Chief Economist, and Head of Research at BGO, a leading global real estate investment management advisor and a globally recognized provider of real estate services. Today, we're broadcasting this discussion live via the recently launched CFOintel.com. After today's discussion, when you get a chance, visit CFOintel.com again and look around. Tell us what you think. And also, I invite you to stick around. At the end of today's discussion, after Marty and I talk about the CFO IntellStats Index, and after Ryan shares his views on world economies, I'll have two special offers for you. Remember, if you have questions, post them in the chat room and we'll address them during today's session. And now let me introduce you to my colleague, Marty Daks. Good morning, Marty. How are you?
Okay, and thanks, Andy. So, question, are finance execs crazy? In September 2025, the H-1B visa fee jumped to $100,000 for certain classes. But in the 2025 Q4 CFO IntellStats report, 75% of executives say hiring challenges have not changed. What's your read on that?
So, Marty, I think, first of all, our CFO is crazy. I think that's a great opening line. What I think is really happening is that we're seeing labor markets finally find equilibrium after years of absolute chaos. Remember, we had the Great Resignation starting in 21. Then we had the quiet quitting phenomenon. Then the mass tech layoffs in 22 and 23. And now, CFOs have fundamentally adapted their operating models. They've diversified their talent strategies with more contractors, more offshore teams. Automation is picking up significant slack in areas that we used to think required human judgment.
So, is the H-1B fee a non-event?
I wouldn't say it's exactly a non-event, but it didn't fundamentally break their hiring models the way people expected. Think about it like this: by the time that the fee hit in September, most finance organizations had already gone through multiple rounds of workforce optimization. They'd already figured out which roles absolutely required specialized talent versus which ones could be handled through alternative strategies.
So maybe they're predicting needs earlier and adjusting before shortages become critical.
Absolutely. I think that is happening. And don't underestimate maturation of the gig economy either. When I talk to CFOs, some say now they can spin up specialized expertise for project work faster than ever before. And if they need a data scientist, for example, for a 6 months analytical project, they can have 3 options by tomorrow morning. The permanent headcount model is increasingly becoming just one tool rather than the single default approach.
And I guess related to that, in the Q4 CFO IntellStats Index, only 13% of executives said tighter immigration rules will mean problems. And that's down from 17% in Q3. But there's a lot of heat around immigration. We're seeing that. So, why do you think CFOs aren't more concerned?
Um, well, a couple things. First of all, I think there are a few different factors at play. One, as we discussed earlier, companies have already adapted their workforce models to be less dependent on a single talent pipeline formula. They've built in resilience. Two, there's probably some discounting of political rhetoric versus actual policy implementation. CFOs have seen a lot of proposed policies that never fully materialize or get watered down in execution. So I don't think they're overly concerned.
So, do you think there's a we'll believe it when we see it attitude?
Yeah, to some extent, and there's a third issue as well. I think CFOs are distinguishing between immigration policies that affect their businesses directly versus immigration policies that are more broadly affecting industry and the general population.
Yeah, there's something else though in the CFO IntellStats report that caught my attention. In Q4, 63% of executives were saying tariffs will have an insignificant effect. That is nearly double what they were saying in last quarter. Do you think they're drinking the Kool-Aid, or have they actually figured out how to navigate this issue?
So more CFOs are saying that it'll have a lesser effect. I'd say it's definitely the latter, and it speaks to something that we don't give CFOs enough credit for. CFOs have a tremendous ability to adapt rapidly and operationalize complex scenarios. So when the tariff talk first ramped up, everyone was modeling worst case scenarios. You had finance teams pulling all nighters, running sensitivity analyses on gross margins, trying to figure out what a 10, 20, 30% tariff would do to their cost structure. It was a mess.
It was, and a lot of those models were pretty scary.
Yeah. And in some cases, they were terrifying, actually. But here's what happened between Q3 and Q4. CFOs moved from modeling to execution. They renegotiated supplier contracts with tariff escalation clauses, which made a lot of sense. They shifted sourcing strategies where possible. They diversified away from the most vulnerable geographies. So they did a lot. They built pass-through pricing mechanisms into the 26 commercial strategies and had those conversations with their customers early. And critically, they stress tested their supply chains to identify single points of failure. So they were on top of this.
So, would you say that the uncertainty premium evaporated since they now have playbooks?
Yeah, exactly. That's exactly what I'd say. It's the difference between theoretical risk and managed risk.
And do you think that could be why M&A appetite appears surging? I'm thinking in the Q4 CFO IntellStats Index, 63% of executives are planning to increase M&A. That's up from 50% in Q3 and just 25% a year ago. Huge shift in strategic posture.
Sure.
What's driving that?
Well, you got a few issues. First of all, you've got a pro-business federal government that certainly helps. Regulatory approval times are much more predictable. Antitrust scrutiny has eased in certain sectors, and the overall tax environment remains favorable for deal structures for now.
Hmm?
But I think there's something deeper happening. CFOs are looking at their balance sheets and in many cases seeing strong cash positions that they've accumulated over several years of very conservative capital deployment. So they're watching interest rates that, while aren't dropping as fast as everyone hoped earlier in 25, they also aren't rising. And according to the data in the CFO IntellStats Index, the data that we've received from CFOs, hardly any of them seem to be worried about interest rates for now.
That sort of floors me.
Yeah. Well, and when you combine that with relatively stable hiring markets, clarity on tariff impacts finally, and,
Mhm.
and supply chains that have largely normalized, suddenly M&A becomes the obvious growth lever. Organic growth in many industries appears to be modest, at least for the foreseeable future. According to the CFO IntellStats Index, it's low to mid single digits. So if you want to hit your board's growth targets, you're either acquiring capabilities, you're acquiring market share, or you're acquiring efficiency through consolidation.
Okay, Do you think we're in a Goldilocks zone? I mean, rates are elevated enough to give sellers realistic expectations. On the other hand, they're not so high that they're squeezing deal financing.
That's exactly right. So I also think that CFOs are looking at demographic and technology trends and realizing that they need to act now. With AI transformation, the energy transition, the aging of the workforce, these are mega trends that mean if you wait, capabilities you need 5 years from now may not be available. Better to buy, the AI startup or specialized engineering firm today, as opposed to trying to build it organically or competing for it against better capitalized acquirers later on.
I think that there may be a potential flashpoint
What do you mean by a flashpoint?
that I'm thinking an issue that really hasn't come up yet, but is significant. Return to office.
Hmm.
2025 Q4 IntellStats Index, that shows that only half of CFOs are seeing a big RTO return to office push right now. That, Andy, is down from 67% last quarter. And I, I guess another issue is 38% plan to actually reduce their physical footprint this year. That is a huge jump from Q3 when that really barely registered.
Mm.
What's happening?
So that's a very interesting set of statistics. The great return to office experiment, or what's also called return to work experiment, it didn't quite turn out the way many thought it would, Marty. CFOs are pragmatists. They follow the data wherever it leads. They've looked at the productivity metrics, the retention statistics, the real estate costs, and they've made hard-nosed, calculated decisions. Here's what I think happened.
Okay.
In Q3, according to our IntellStats Index, there was still this lingering belief, maybe hope is a better word, that companies could mandate people back to the office and recreate the productivity and work ethic that they had before 2019.
Yeah, a return to normal fantasy. I wonder what they were smoking.
All right. Okay. Well, maybe they were smoking something, but by Q4 25, the data actually became undeniable. Productivity did not always improve with full-time return to office, return to work mandates. In some cases, it actually decreased as some companies lost their best performers because those people had options and many chose to leave and go elsewhere or retire rather than commute again.
Okay, back to the statistics though. 38% of executives, again, this is based on the CFO IntellStats Index, they're saying they're planning to reduce footprint. Do you think that can have a massive impact on commercial real estate, especially in secondary markets?
Depending upon timing, it actually could.
Mhm.
We're going to see a continued bifurcation of demand for space.
We've seen that.
In both office and industrial sectors, Class A real estate in premium locations, that segment has always held up over time because companies want flagship facilities either for headquarters purposes, important client meetings, executive presence, collaboration spaces, as well as the highest quality manufacturing distribution spaces.
Reasonable.
Of course, but across all segments, office, industrial, and so on, Class B and C space, suburban and industrial office properties, older buildings in particular, without the amenities or efficiencies that today's workers expect, those are going to get crushed. We're already seeing that. And CFOs planning footprint reductions, they're going to accelerate that trend toward better quality.
Okay, but there's also a flip side. The CFO IntellStats Index also showed 25% of executives planning to actually increase their facility space.
Yeah.
What kind of companies do you think makes up that segment?
You've got, different CFOs in different industries looking at different futures, if you will. So it's a very good question. I'd bet that that cohort breaks down into a few categories. One, you've got companies that are generally growing headcount in manufacturing or logistics. In those cases, there's a physical need for space, and they have to have those operations in that space and those people in that space, not just
Valid.
office workers. Two, you got companies that overcorrected by downsizing during the pandemic and still haven't recorrected and now realize they actually do need facilities for effective collaboration, production, distribution, depending upon what they're doing, just not at 2019 levels in many cases. And the third issue, Marty, is companies in sectors where in-person work is absolutely required. Healthcare, hospitality, manufacturing, distribution, as I mentioned, retail, where you can't remote work your way through the job, they've got to address real estate.
Valid, but at the same time, there's a drop in CFOs who say they're focused on real estate issues.
Yep.
Um, we saw that plunge from 58% in Q3 of 2025 to just 13% in the Q4 IntellStats
Yeah.
report.
I think that's certain CFOs, many CFOs saying, we've made our real estate decisions. Now we're moving on to other priorities. For those companies, consolidations have pretty much been done. They've already executed. The footprint's been right sized based on current workforce models and projected for growth. And the waiting game on interest rates as it affects real estate, that's essentially over. Rates are what they are, and CFOs have either refinanced what they could, or real estate and otherwise, or they've accepted the new normal.
So, are you saying that the focus shifted from real estate to operational execution? I mean, that that makes sense. Back to the CFO index in Q4, the results indicate executives are focused on areas like M&A, cybersecurity, HR, sales, and supply chain.
Yeah, that's exactly right, Marty. For many companies, the real estate plan is now a solved one for the most part, or at least a managed one. Others are still trying to catch up.
Okay, but CFOs still going to have to manage lease exits, subleasing space, consolidating location. That's not exactly trivial.
No, it's not, and you're absolutely correct. But that's more, that's an everyday thing. That's more of a tactical execution than than strategic decision making in most cases. The strategic decision in the context of what we're talking about has been made. They reduced footprint. Now it's just project management to execute, and whether they'll continue to reduce or grow or remodulate their portfolios, that's a different story. But that doesn't rise most likely to the level of top focus for the typical CFO, at least directly, at least not in larger companies.
Agreed, but as significant numbers of people continue to work remotely, I'm thinking CFOs will still have to address uh, technology spend.
Yep.
Okay, because if consequential numbers of people are not working from the office, you damn well better have world-class digital infrastructure. Question is, can they execute on it?
Mm.
And the reason I guess I wonder about this is because at the end of 2020, again, according to the IntellStats Index, 56% of CFOs said significant tech impact would be a factor in their companies. But remember, that was the end of 2024. By Q3 2025, we saw that crater to only 17% focusing on tech. 1 quarter later, Q4, there's a whiplash back to 38%.
Yeah.
What what do you think's happening?
You know what? It's a perfect illustration of the Gartner hype cycle playing out in real time. At the end of 24, AI was going to solve everything, right?
Hmm.
Every vendor was slapping AI powered on their marketing
Oh,
materials. CFOs were getting pitched AI solutions for problems they didn't even know they had. It was the peak of inflated expectations.
okay. And then maybe reality set in.
Yeah, yeah, that's exactly what happened. And it set in hard. Q3 was the trough of disillusionment as well.
Okay, but what changed by Q4? I mean, this sudden jump
Yeah.
back to 38%
Yeah,
focusing
and
on.
it's an interesting set of stats because the companies that stuck with it and did the hard work, they started realizing early results. For example, AI powered forecasting models that actually improved forecast accuracy, chatbots that reduced support costs without destroying customer satisfaction,
Mhm.
things like automated reconciliation processes that eliminated thousands of hours of manual work. The successful implementations actually became proof points and they started to pay off.
So it almost sounds like we're at a stage where people can actually point to hard ROI numbers.
To a point, yes. But while some companies are becoming satisfied with their AI ROI, others still aren't. And a lot of them still aren't. And that's reflected in the technology budget boosts that we're seeing reported in the CFO IntellStats Index. While 38% planned significant increases in Q4 compared to just 17% at the end of Q3, as you mentioned, you still have the majority of companies who have yet to achieve satisfactory ROI as it relates to AI.
Okay, and I guess to your point, 38% in Q4, that's substantial, but it still means 62%
Yeah.
are not seeing significant impact yet, or they aren't prioritizing AI investments. I think that represents a massive opportunity gap.
Yeah, I agree. And I think we'll see that gap close over the next few quarters as the
Hmm.
laggards see competitive pressure from the early adopters. If you're running a company and your competitor is using AI to
Hmm.
deliver faster customer service, more accurate forecasting, lower operating costs, you can't ignore that forever.
True.
I think the tech budget increases in 26 that we're being told by CFOs that they're planning, they're going to be fascinating to track.
Probably will be. Let's take a look at another issue, inventory management.
Mhm.
Um, when I look at the 2025 Q3 CFO IntellStats Index, 25% of execs plan to expand inventory, but in Q4, hardly any planning inventory expansion.
Mm.
In fact, a quarter of CFOs said they're planning to trim inventory. Andy, are they leaning back into just in time, even after the supply chain fragility we saw in 2020, 2021, and 2022?
To Marty, to some, just in time is a four-letter word. It's but to others, it's either brilliant or very risky, and that really depends on your perspective and which industry you're in. On the one hand, only 38% of CFOs expect supply chain disruptions in the coming year, according to our index, and that's down from 50% in Q3. Now that shows real confidence that the chaos of the early 20s, at least as it relates to supply chain, is perceived to be behind us. Ports are functioning, shipping rates have normalized, supplier relationships have stabilized, so things look good. From a pure financial perspective, inventory ties up working capital. If you can reduce inventory significantly by 10 or 15% without increasing stockout risk, well, that's cash you can redeploy, and you can redeploy it into anything: M&A, hiring, technology, debt reduction, or give it back to shareholders. The return on investment capital calculation for this is compelling.
Yeah, but if we hit any kind of supply shock this year, don't you think many of those CFOs are going to regret that decision to cut inventory?
Yeah, I do actually. Risk management, though, is always about trade offs. But I think 75% of CFOs who plan to keep inventory levels steady, they're showing appropriate caution in doing so. They're not expanding, but they're not aggressively cutting either. So that's a prudent middle ground.
Where do you think, though, the biggest surprises will be as we move through 2026?
Um, Based on what we're being told, I think the M&A surge is going to be real and it's going to be substantial. The 63% of executives in the CFO IntellStats Index who've reported that they plan to increase activity will translate into an active deal environment, probably strongest in the middle market, where strategic acquirers are shopping and private equity has capital. The
Mhm.
middle market, though, isn't quite as active yet, but I think that's going to play out.
Okay, so based on what we're hearing from executives, I'll agree with you on M&A. Any other surprises?
Yeah, I think the inventory and supply chain confidence could be tested a bit. If we get a major disruption, whether geopolitical conflict or natural disaster that affects manufacturing regions, or even labor actions that are significant at critical infrastructure points, those CFOs who aggressively cut inventory, for example, they're gonna face some painful quarters. And I think
Sure.
AI spend is going to accelerate even beyond what the numbers in the CFO IntellStats Index suggest. As successful use cases become more visible and competitive pressure intensifies, I feel very strongly that we're going to see companies that were sitting on the sidelines scrambling to catch up. That could create some very interesting bottlenecks in AI talent, for example, and then implementation capacity as well.
Do you think that could drive a return to hiring challenges that we've seen previously?
Um, Yeah, I do actually. We could see very specific talent squeezes in areas like AI engineering, data science, cybersecurity, and you know roles that around those. Especially if companies are simultaneously trying to execute M&A integrations that require change management expertise, and technical talent.
So, in the Q4 CFO Intel Stats Index, the 75% of executives who say hiring challenges won't really be changing. Do you think they're underestimating the odds of specific pockets of talent scarcity?
Uh, it's possible. Although CFOs might be taking a portfolio-wide view,
Hmm.
I actually think they'll have challenges hiring AI talent, but they're also reducing headcount in other areas and automating roles partly due to AI. So net, hiring challenges should stay manageable. They may exist, but they'll be manageable.
Okay, so some equilibrium. Last question, Andy. If you're a CFO reading this data, what's the one thing you should be doing that maybe you're not doing yet?
Yeah, good question. Scenario planning and stress testing. It's actually two things. Um, all day long. The confidence in the data that we've received in our index is warranted the confidence is warranted based upon current conditions. But remember, conditions change, right? So, and sometimes they change quickly. CFOs hope that they never need alternative playbooks, but just like insurance policies, having them ready means they can act proactively rather than reactively when things go sideways, and from time to time they do.
It happens.
Those CFOs whose companies come out of the next crisis in strong positions will not be those who predicted the crisis. Nobody can do that reliably. Those CFOs will be the ones who prepared for multiple scenarios and could execute quickly when their particular scenario hit.
So if you're synthesizing all of this for a CFO audience, what's your headline?
And I like headlines.
You do.
Marty, I'd call it strategic confidence returns. The best CFOs have decisively moved from reactive crisis
Mhm.
management to which pretty much defined 2020 through 24, or at least part of 24, to proactive strategic positioning. Those CFOs are not waiting for clarity anymore. They're creating clarity through action. They've adapted to the H-1B reality. They've modeled around tariff scenarios, and they've built mitigation strategies that have right-sized their real estate. And they've moved past the AI hype cycle into actual deployment. And they're deploying capital toward growth, whether that's M&A, technology investments, or a combination.
Okay, but is this confidence justified, or do you think CFOs could be underestimating tail risks?
Tail risks. That's the eternal CFO dilemma, Marty. You have to project confidence as a CFO. You got to project confidence to your board, to your CEO, your leadership team, your peers, your investors, your employees. You have to make decisions and commit capital. That's the role of the CFO. Can't be paralyzed by every possible risk, but you do have to be aware. And simultaneously, you've got to stress test for scenarios that you desperately hope will never materialize.
If I can springboard off of that confidence theme,
Yeah.
um, I noticed that our CFO IntellStat Index findings, they're aligning with the top line findings of another survey, the one launched by the Richmond Fed and Duke Fuqua. Moderate growth expectations, widespread AI spending increases, particularly among small firms. Does that kind of external validation, Andy, make you more confident in the trends that our CFO IntellStats Index are highlighting?
Well, first of all, to be tracking with surveys as prominent as as the one you just referenced feels pretty good. It tells me that we're doing something right, and CFOs are communicating with us, and it certainly adds credibility. When you see consistent signals across multiple surveys where different methodologies are deployed and with differing sample populations, well, that suggests you're picking up real sentiment shifts rather than statistical noise or just simple bias. The Fed Duke Fuqua survey is particularly well respected in the CFO community. So our index being aligned, I think that matters a lot. And like I said, it's pretty exciting.
It is. And I think we unpacked a lot of insight today, Andy.
I would agree, Marty. The overall message here from us to CFOs is maintain cautious optimism, but with a healthy respect for the fact that CFOs are operating in a very dynamic environment where assumptions can be invalidated quite quickly. Name of the game is stay confident, stay prepared, and stay flexible.
It's great advice, Andy. And by the way, if you are as good as picking lottery numbers as you are at trend analysis, I'm going to stop by soon.
All right, you got a deal. Marty, this has been a great conversation. Thanks for partnering with me on this. I really appreciate your efforts on the CFO IntellStats Index. I'm going to ask our producer, Joe, for those who are watching, to post the recent CFO IntellStats Index in the chat room now, if he hasn't already done so, so our guests can download it. And once you download it, you have a chance to look at it. If you have some questions, you have some challenges, you disagree with us, reach out. Love to hear your thoughts. Now, to our guest, as I mentioned earlier, I want you to stick around. I'm about to introduce you to our guest today, our guest expert, Ryan Severino. But after Ryan's comments, I have a couple of special offers for those CFOs who are in attendance today. And so for now, please permit me to introduce you to our guest, Ryan Severino. If you have questions for Ryan, or if you have questions for Marty and me, if you haven't already done so, post them in the chat room and we'll address them after Ryan completes his comments. Ryan Severino is Chief Economist and Head of Research for Bentel Green Oak, also known as BGO. The company is a leading global real estate and investment management advisor and provider of real estate services globally. Ryan Severino brings 25 years of economics, real estate, and investment research and analysis to his role at BGO, having previously served as chief economist for another global real estate services company. Ryan served as senior economist and director of research at Reese in the Research and Economics Department and was responsible for the firm's market forecasting, valuation, and portfolio analytics services. He served as associate director of research at MetLife Real Estate and director of investment strategy and market research at Starwood Capital Group. So as you can tell, Ryan's a real slouch. Ryan is a member of the Chartered Financial Analyst Institute, CFA Institute, the American Economic Association, the National Association for Business Economics, Urban Land Institute, and the National Council of Real Estate Investment Fiduciaries. Ryan holds a master's degree from Columbia University and a bachelor's degree from Georgetown. He's an adjunct professor of finance and economics at Columbia University and NYU, and his original research and/or market conditions assessments have appeared in the Wharton Real Estate Review and the Real Estate Finance Journal, The Economist, the Wall Street Journal, New York Times, the Financial Times, and he's appeared on CNBC and Bloomberg. It gives me great pleasure to introduce you to Chief Economist and Head of Research for BGO, my friend Ryan Severino. Ryan, thanks so much for your comments. I really appreciate you being here. Thanks for joining us.
Andy, thanks for having me. It's always nice to see you. I thought what I would do with everyone today is walk you through. I've been thinking about the economy in terms of themes. It's certainly an interesting time to be discussing the economy. I could probably always say that, but it is an objectively interesting time. And I find that if I frame it a little more around the idea of a theme as opposed to walking you through some particular narrative, it really highlights a lot of the major things that certainly I'm thinking about, that my clients are thinking about, that I get asked when I'm presenting at conferences to third-party audiences. And I think it really helps to hit the high notes as opposed to just, as I said, following a predetermined narrative. So it might seem a little bit disjointed, but I promise you that there's a coherent narrative with this. So if you follow me along, I will get you from the beginning to the end. I think what is really relevant, certainly to I think a lot of people on this call, but really in the world today, is that the capital markets are in a very interesting place. Capital is really the lifeblood of how the economy functions. For those of you who remember the financial crisis of 2008, 2009, if we didn't have a functioning capital market, if we didn't have a functioning banking system, then everything else on top of that, to use a tired real estate analogy, that foundation of the economy falls apart. Almost everything else doesn't matter after that. And we've gone through a period over the last few years where there's been capital scarcity as the Fed and other major central banks around the world aggressively raised interest rates hundreds of basis points. Capital wasn't so cheap anymore. It wasn't as readily available anymore. And we went through a period where capital was really restricted. We're not back to what I would call a normal capital markets environment, but with the Fed and other major central banks slashing interest rates hundreds of basis points, the capital markets have started to ease. We're starting to see greater availability across instruments on the equity side and the debt side. So we're not back to exactly where I would characterize it as a healthy environment, but certainly we have made a lot of progress, even if there have been some bumps in the road along the way. But what's interesting about that is that even in an environment of capital market scarcity, there are a few places you look around the world, you can find significant amounts of capital. So the first place I'm going to start with that is in manufacturing. You've probably heard this word deglobalization being bandied about a little bit. The world is clearly pushing back a bit against the deglobalization of the last 30, 35 years since the early 90s. They're doing it in a very capital intensive way, which I find just kind of unique given where advanced economies are. Once upon a time, we would have thought advanced economies evolve somewhat linearly, going from agrarian economies to manufacturing economies to service economies and then technology economies, whatever the next stage of evolution happens to be. But that's not what we're seeing. There has been a significant pushback against this globalization of the last few decades. And now what you're starting to see is, I don't want to make it sound like we're going back in time, but you are starting to see a push more for manufacturing in parts of the world where maybe we thought it wouldn't come back, or we hadn't moved past that stage of evolution. And if you look at the data, I'm specifically thinking about the data in the United States, but it's certainly true in other advanced economies of the world, you have seen a significant increase in the construction of manufacturing facilities. Now, this isn't, manufacturing of textiles and toys and consumer electronics. It tends to be things that are a little more sophisticated, electric vehicles, batteries, semiconductors, specialty chemicals, aircraft. But there is a very significant increase in that kind of investment in the United States and other advanced economies in just the last few years. And that is really sort of one of the hard lessons of the pandemic, that the supply chain of the last 35 years evolved to be efficient, but it didn't evolve to be resilient. And now you're seeing the world correct a little bit on that. So that's the first place that we're actually seeing some interesting exception to this capital scarcity phenomenon. The second place, which is something that I think everybody is abundantly aware of, I heard Andy and Marty chatting about this a little bit too, is AI. And I tell you this not just as an economist who pays attention to the economy overall, but as someone who is, this is going to sound a little more arrogant than I mean it, a very advanced user of that here at BGO and myself personally. We might have gone through a period where it felt like AI is hype. But if that's the case, it really comes down to people not implementing it correctly. The way I've been thinking about it is that AI is an economy-wide technology shock. When I try to explain it to people and what it can do and how I use it, it sounds like science fiction, but it's really just science. It feels supernatural. It feels like it should do things that it does things it shouldn't be able to do. But it actually does those things. If you look at the data and you look at the amounts of money that are being spent on this technology, they're not just high on an absolute basis. If you measure the amount of investment in AI relative to the size of the economy, because that's always the fairest way to measure something like that, it eclipses anything that we've seen before. It eclipses the amounts of money spent on telecommunications and the internet. It eclipses the amount of money spent on the Apollo program, the amount of money spent on the interstate highway system with Eisenhower, the amount of money spent on electrification. And I mean the original stage of electrification, not the electrification we're trying to implement right now. Like really back when we first electrified the economy. Nothing compares to this. And we are not done spending money on this yet. If anything, now that organizations are increasingly realizing the benefits of this and what it can actually do for them in terms of insights and productivity, the dollar amounts continue to be substantial. This really, if I can take my corner of the world, which doesn't seem all that significant, and I think about all of the ways it's really transformational, and then I expand that out to the rest of the world that I don't know as well, but I can only imagine. Medical diagnosis, pharmaceutical development, things like that. The sky is really the limit with this technology. I try not to speak in hyperbole about things, but the world is really evolving to a point where this technology is substantially a game changer. And so I'm just trying to caution everyone, because I have seen people I know in other organizations go through fits and starts with this adoption of this technology. But once people figure this out and get it down, you're starting to see it improve productivity data. You're starting to see greater output and greater insights. I don't know if it will quite be as transformative as the internet per se, but it certainly has that potential. So buckle your seatbelts. It's going to be an interesting ride. And the last thing within the confines of what I'll broadly call this sort of capital change, I really want to talk about China, and just to be objective about this. I'm not a China basher. I'm not a China hater, but you might have heard last year China had a $1.2 trillion trade surplus. It's the largest in history. No other country has ever not even China has ever generated a trade surplus that large, $1.2 trillion. It sounds like that superficially is a triumph for the world economy, but what's really happening there is that China is, because of the way the economy is structured, they don't really allocate resources as efficiently as we do in a more market-oriented economy. So what are they doing in terms of capital and then related activities? Well, the first thing is the government subsidizes investment there. It's sort of the bargain that they've kind of made between the government and the population, is that they'll be pretty good stewards of the economy as long as people don't feel like they want more political power. And because of that, the government is, and I'm saying we don't do this in the United States or other parts of the West, but the government is pretty substantially subsidizing construction and manufacturing across a large swath of China. So it makes it easier to just go out and build productive capacity. And the second thing that's really gone on there is they don't have really good domestic demand. And a lot of that is because in order to make the production of goods more competitive, they have artificially suppressed wages in China for a lot of the last 30 to 40 years. And so labor cost isn't as high in China as it otherwise would have been in a more market-oriented economy, which, again, also filters through to capital production. It makes all else equal, which I know is a very economist thing to say, it makes the production of goods cheaper than they would otherwise be. And then the third thing that they really do, which is also capital related, is they manipulate their currency. They make the currency such that purchase of their goods is relatively cheap. And what they effectively did is they are effectively engineering a pretty efficient way to export, because they don't see developed domestic demand in a domestic market to absorb a lot of the productive capacity that they have built up. But what are they doing? Well, once upon a time, I would have told you that they are exporting to the largest market and consumer market in the world, the United States. But you might have noticed that the current administration is playing a little more hardball with China than we've seen previous administrations in the past. And as a consequence of that, imports from China to the United States have declined substantially this year. So where did that $1.2 trillion then come from if they're generating record trade surplus? Predominantly Europe and other parts of Asia that have not pushed back against trade with China as much as the current U.S. government has. And what that means is a lot of these goods are being sold into these markets at very low prices below which a lot of, I'll loosely use the term domestic in the EU, that's a little more of a region than a country per se, but then domestic production can compete with. And that runs the risk of potentially hollowing out productive capacity in some other parts of the world. My sense of this is maybe not to the extent of the United States, but you might see some other parts of the world more stringently pushing back against free trade than they have been, as they increasingly come to the recognition that this is not going to be costless or riskless for their domestic economy and manufacturing bases. And so very interesting capital markets environment that we're going through. It is liberalizing and it is going back to normal, but very slowly. And there are certain pockets of it where if you look, you can find pretty substantial activity. So what does that mean for the macro environment? I wanted to start with this through the lens of capital because interestingly, which I say without the positive connotation that I think most people affix to the word interesting, capital has really been the driving force in the U.S. economy over the last, call it 12 to 18 months or so. And because the U.S. economy is still such a substantial part of the global economy, it also has knock-on consequences for the global economy. And if, I'm going to do something that is difficult to do, I'm going to do the counterfactual in economics. But if we did not have those galactic amounts of capital being spent on AI and related technology last year, I don't think the U.S. economy would be in a recession per se, but growth would probably have been anemic. It probably would have been close to stall speed for the economy, and we would actually be worried about the potential for falling back into a recession. Recession is not the base case. I still do not think a recession is inevitable. I've been saying that pretty much since even before the Fed started raising interest rates and inflation spiked in 21. That's a small hill that I'm still willing to die on. But I do want to emphasize that relative to cycles past, you are seeing a much bigger boost from capital expenditure than we have seen in a very long time. And that differentiates this phase of the cycle from previous expansion phases that we've seen in recent decades. What that also means, thankfully, though, as the economy continues to grow, it's also benefiting from the fact that inflation has decelerated considerably since it spiked in the wake of the pandemic, when we really reopened the economy on the demand side very quickly, but it took production a little bit of time to catch up to that. The U.S. is a little bit of an exception here. Just objectively, trade policy last year caused inflation to reaccelerate, probably 70 to 80 basis points on a year-over-year basis. But the good news is, if you net that effect out, inflation in the U.S. It looks like a lot of the rest of the world, we're pretty much back at Fed central bank target. If we measured housing inflation correctly, which we don't really do, I'll save that punching bag for another time. We might actually be below target inflation in the U.S. And so that also really helps the economy grow, because as inflation decelerates, you have greater real spending power. And I emphasize that because, consumers were not out of the game here. It's not just all capital expenditure all the time, but inflation has a lot to do with the improvement in consumers' ability to spend after having gone through a period of such multi-decade high inflation in 2022, 23, before it really started to abate. What's interesting about this environment is that even as growth has continued and inflation has decelerated, the labor market has entered a phase that doesn't feel congruous with the economic environment. I've been calling it, and I think other people have been calling it, the don't hire, don't fire labor market. And the way that I think about this is, the labor market usually is, it's a cyclical phenomenon, but you can usually tell a lot from the labor market by the data, right? If unemployment's high, it's not a great labor market. If it's low, it's not a great labor market. If we're creating a lot of jobs every month, it's a strengthening labor market. If that number is weak, or if it's negative, you might characterize it as a not so great labor market. But it's not really what's going on right now. What's going on is that a lot of frictions are slowing the labor market down, even though I would say in aggregate, it's still a tight, healthy market. My best analogy for this is a duck on a pond. If you've ever seen a duck on a pond, on the surface, it doesn't look like anything's happening, but underneath the surface, its legs are kicking a lot. That's kind of the labor market these days. There are a lot of things going on the supply side of the labor market. There are a lot of things going on the demand side of the labor market. But in aggregate, we're just not seeing a lot. So what kinds of things, right? And again, not to be remotely political, but we've had to clamp down on immigration, which has slowed the labor supply growth in the United States. We're getting older every day, literally and figuratively in the U.S. And so we're going through substantial demographic change, which slows the labor force growth rate. But then on the demand side, we've also had a significant slowdown in hiring because of the policy uncertainty that we've been dealing with over the last year. A good amount of that has been what I'll politely call mercurial trade policy, to really be polite about it. But we also had fiscal policy. We had a government shutdown in the United States. We still have some monetary policy uncertainty as the Feds kind of had to navigate somewhat uncertain and choppy waters as trade policy has bounced around a little bit, and fiscal policy has been somewhat unpredictable. They've had to be a little more reactive than they might otherwise like to be, and so that creates this environment where there's a lot going on not a lot going on the surface, but there are definitely a lot of things going on underneath. And that brings me to sort of the last thing I want to talk about, which connects all the way back to the beginning, is that we are still in a loosening monetary policy environment. And most of the major central banks around the world have brought their policy rate back down to what they think is an appropriate target rate. It differs from place to place, but I think most of the easing you've seen on the part of the Bank of Canada, the Bank of England, the European Central Bank, probably completed at this point. The U.S., I think I don't expect to see as much rate cutting this year as we've seen over the last 2 calendar years. I don't think we need it. I think the Fed is going to be cautious, given that they do have a balancing act between somewhat tariff-induced elevated inflation and what seems to be like a slowing labor market. But objectively, it's fair to say that we're probably above the neutral rate. Maybe a cut or two. I wouldn't expect them to be more aggressive than that unless the economy falters in a way that I don't expect. Bank of Japan is the interesting outlier here. For almost maybe not the entirety of my lifetime, for at least the last 36 years, they've been dealing with low inflation, if not outright deflation. So it's kind of amusing to me in a sense that that's the part of the developed world where they're still seeing somewhat persistent inflation, and the Bank of Japan is still raising rates. But they're kind of happy about that, to be honest, after maybe 30, 35 years of not much inflation or outright deflation. And what that means is capital markets should continue to ease over time. Interest rates should continue to come down. Debt availability should continue to increase. And that reinforces all of the things that I talked about earlier, all of those places that we're seeing capital migrate across the different parts of the economy. That should be easy. But it also should support all of those macro things that I was talking about. Economic growth, what's going on in the labor market. Lower interest rates is not a panacea that ails everything, but all else equal, which I know is a very economist thing to say, it generally it greases the skids a little bit, to use a little bit of an antiquated expression. And we're already in an environment where there's a lot of capital being spent in certain places. We keep cutting interest rates. That really widens out from a pretty narrow aperture to something much larger. That's why I'm still willing to die on the small hill that an economy is not inevitable. So I think that's a pretty good place to wrap up my remarks. I'm going to kick it back over to Andy, but I'm not going anywhere just yet. Andy, back over to you.
I love your energy, love how you view the economy in total. I mean, it sounds to me like, with the various comments you've made, that overall you feel that we're in a strong economy, or at least entering one, and you have positive views for 26. Is that a fair assessment?
Yeah, somebody asked me this week, where in the cycle would you characterize this? And it still feels decidedly mid-cycle to me. We're not in the initial stages of coming out of the pandemic-induced recession. We've clearly gotten past that. But I look at the economy and I don't see, the normal imbalances that end an expansion phase of the business cycle. I don't see them. I don't see excessive leverage. I don't see central banks tightening too much, which leads me to think we probably have some good runway ahead of us. It's hard to say exactly how long, but if recent history is any suggestion, we could have at least 3, 4, 5 years of runway ahead of us. So I still feel pretty good about where the economy is headed over the medium term.
That's excellent news. Now, let me ask you a couple of questions. You spoke about China at length, and my impression, tell me if I'm correct, my impression is that you don't see China as being the major economic threat, or at least as much of a major economic threat to the U.S. as it used to be. Is that a fair assessment?
Yeah, at least in terms of how we think about trade policy and goods. And again, I want to be careful. I'm not a China basher. I'm not a China hater, but a lot of what they would have normally exported to the U.S. is getting funneled to other places. And that's a little bit of a problem, right? On the one hand, you could say, well, that's just a reallocation. But on the other hand, that's a lot of stuff that used to come to the largest consumer market in the world that's going somewhere else. I think we sometimes overstate how much we import in the U.S. relative to the size of the economy. It's actually not that much. But in terms of the availability of goods, I don't think you're going to see them nearly as, you've probably noticed this at the margin, that you don't see as many things from China for sale as we once did. And that's just because we're playing a little bit of hardball on trade policy right now.
Right. And it seems like as the economic effect of China as it relates to the CFO reduces, it's not going to one particular place. And it sounds like we don't have to worry about the rise of a replacement competitor to that of China. It sounds like it's being diversified and spread around the world.
Yeah, at least in terms of goods production, I think where the competition is a little more direct these days, which might be underappreciated by people, is more on the technology side. I think there's a little bit of this misperception that China just goes out and copies the world. There's some of that going on. I don't want to make it sound like that's not the case, but China has now become, at least in aggregate, we could quibble about the quality of some of it, but basically the largest R&D center in the world. If you look in terms of the number of papers that are getting published, the number of patents, the spectrum of technology, some of which China is just far ahead of the rest of the world. China is so much farther ahead of the rest of the world in terms of solar photovoltaic cells. It's far ahead of the rest of the world in terms of electrical battery storage. It's far ahead of the rest of the world in terms of electric vehicle production. So that's where I think, the world is probably still going to have to grapple with that challenge. They're probably better on that kind of advanced R&D side than people who think they still make just, textiles and toys and basic consumer electronics or something like that.
Right. And sneakers. Right.
Yeah.
So you mentioned before about a significant uptick in construction in the U.S. and elsewhere, you said, in the manufacturing sector. What's really driving that?
Some of it is this concern about fragile supply chains. There is this somewhat belated recognition on the part of advanced economies that supply chains that evolved for efficiency have vulnerabilities. If you are only producing one really critical thing in one part of the world and then something disrupts that, then there's a problem. And we didn't even really, and it's a shame on us almost as a society to say that, but we didn't need a pandemic to show us that. If those who are old enough to remember, probably everyone on this call, but in the early part of the last decade when we had the Fukushima earthquake, there was a lot of productive capacity in Japan that was taken offline and things that only Japan produced. And I'm not pushing back against, economics 101 specialization and getting better at things. I'm simply saying for things that are really critical, national defense, pharmaceuticals, et cetera, it probably makes sense to be a little more resilient and be a little more redundant. And I think the other thing is somewhat this, again, a little bit of a belated recognition that economic evolution doesn't have to necessarily move in one direction, that we can still be a manufacturing economy. Again, not textiles and toys and consumer electronics, but we can still manufacture in the US. We just have to focus on the right things. And so some of it's government policy from the previous administration, some of it's government policy from the current administration. But I think that's the key thing, that we realize that it's not the greatest idea to be dependent upon one or two parts of the world, especially if those one or two parts of the world are geostrategic rivals. And again, I don't want to name any names and I'm not bashing on any countries, but that's a legitimate concern in 2026, thinking about where the world is going.
Sure, that makes perfect sense. With respect to AI, you were very focused on AI as the rest of the world is today. Are you concerned at all with the significant capital investment that's being made into AI these days, that as a society perhaps, or industry in general, that we're at risk of funneling too much capital into one single direction?
There's definitely a risk of that. And to be fair, there are a lot of, to channel my inner Donald Rumsfeld for a minute, there are a lot of, sort of known unknowns out there and unknowns out there. But what I would say is I think about it almost akin to what the world was like during the dot-com bubble or somewhat similar to that. The technology was revolutionary and amazing. And I sincerely believe that this technology is revolutionary and amazing. But that didn't prevent people from getting over their skis a little bit, at least too soon. This has been the fastest adopted technology in human history, but that doesn't prevent us from having potentially equity valuations that are too high or putting too much capital into something. If you ask me if it's going to transform the world over the next 20, 30, 40, 50 years, my answer is almost certainly yes. Because again, I see what it can do for me. I can only imagine what it's ultimately going to do for everyone else. But again, that doesn't mean that maybe we don't get the timing exactly right on this. It's funny, working for a firm that does a lot of private capital, but certainly specializes in commercial real estate. It's the one property type where developers are still excited about developing. And across the other, major minor food groups of commercial real estate, they're not particularly excited these days, but data centers still get a lot of people hot and bothered. And so I believe in the technology over the medium to long term, but that certainly doesn't completely preclude us from potentially investing too much too soon if we get too excited about this, somewhat akin to what we saw with .com, where it did change the world. I mean, we're having this conversation right now based on a lot of evolution that's happened, at that point and since then. But Pets.com was never worth $48 billion per share or whatever it was trading for at the time.
Let me bring you back to China one more time. You mentioned that China basically engineered their economy and the effect that they have on others, in one case by suppressing wages. Do you think they'll be able to maintain that, or will their success or anything else that they're doing force those wages back up?
My sense in the long run is it's going to be difficult for them to do that, at least as assiduously as they have been doing it. I know that
meaning for them to maintain suppressed wages.
Yeah. The market mechanism doesn't function there the way that it does in say the U.S. or Europe or Japan or someplace like that. But if they don't ever grow domestic demand, then that problem just builds and builds and builds. So let me just give you a quick explainer why. They designed their economy specifically over the last 40, 45 years to be very manufacturing intensive and then to export to the rest of the world. They looked at the experience of Japan and some of the Asian tigers, and they said, we can do some of that, right? We're not high education yet, we're not service oriented yet, but we can be competitive in manufacturing. And so they effectively engineered their economy to be a manufacturing and export powerhouse. But part of the way they did that was keeping wages low. The issue becomes, if you don't ever grow wages, then you don't develop that domestic demand. What happens is you eventually build up productive capacity in excess of what can be absorbed. And you're starting to see that now. They're having to export to the rest of the world because they can't absorb that. And if that's the case, then they're going to seriously constrain the size of their economy because the rest of the world can only grow so quickly, can only absorb so much of this. And so for as much as I might say the U.S. is a little too consumer-oriented sometimes, China kind of has the opposite problem where because people aren't paid really well and because they don't have a great social safety net and it's expensive to grow old there, they don't develop the consumer side of the economy enough. And that ultimately limits them, especially because if you think about building all of this property, plant, equipment, and infrastructure, that's not like a set it and forget it sort of thing. That requires additional capital to be maintained. So it almost becomes like a death spiral. Unless you want your factories and your bridges and your tunnels to become obsolete, you have to keep spending capital on that. And that's why it can run really well for a while, but it almost by definition collapses in on itself.
So I guess my question about labor, though, in the U.S. is something that keeps running through my head. The fact that we've got such a dearth of skilled labor, is that going to be the Achilles heel of our economy?
It's not the kind of thing that could outright cause a recession itself, but it's already limiting our ability to grow. U.S. economy grew, I'll ballpark it because the data is not finalized. Let's call it 2% last year. We can probably grow about 2.5% this year, give or take. But the major input to product for all of this discussion about capital, which is correct and a good way to lens through which to view what's going on, we are still the major input to production in the United States in 2026 is still labor. And if we do not have the labor supply growing, which it really isn't growing right now, then we're going to have to rely on almost everything else. Capital expenditure, productivity growth, those things are obviously related to each other. But it's easier to read that in an economics textbook than it is to say, well, we're just going to invest in capital resources and we're going to make our economy more productive, and then we'll increase productivity growth, and that will offset what's happening on the labor side. I love Japan, but Japan's exhibit A for that. Japan has done as good of a job as they can investing in capital and trying to boost productivity because they have a serious demographic challenge there. We're not Japan and we're not there, but yeah, limiting the labor force also limits economic growth here, no doubt about it.
Sure. Now, I guess, Ryan, for my last question, you mentioned that capital is a big driver of GDP. If consumer spending is not driving GDP in this country, how sustainable is economic growth?
That is the multi-trillion-dollar question. In the short run,
thank you.
It doesn't seem like these voracious appetites are going to be satiated anytime soon. But we are a consumer-driven economy. It's called 70% still of the demand side of GDP. and I don't want to make it sound like it's zero. Like we are still spending money. We're not spending money as quickly as we once did. Ideally, I'd like to see those things maybe in better balance. I don't like this idea that we're just going to try to whipsaw between being, very, very consumer driven and then very sort of capital investment driven. So if we could get to some place where maybe the capital is for investment is deployed a little more. Trying to think of the right word without sounding incendiary. A little more consistently, a little more, thoughtfully, maybe even. And consumers just don't go through, we always spend money. That's what we're still the best at in the U.S. economy. But, if consumers could also be like a little more thoughtful, I think that not just only helps in terms of efficiency, but it also helps in terms of, diversity of economic drivers. It's harder to cause an economy with multiple economic drivers to go into a recession. If you're just going to, bet most, if all of your chips on one number and that number doesn't hit, it increases the probability that you fall off the wagon for a little while.
Ryan, this is great. I can't thank you enough for joining us here today. You've been with us a number of times at our other events, and you've always shared very interesting insights, and we've always had phenomenal feedback from the comments you make. So I want to thank you today for being with us, for sharing your insights. You've always put forth great conversation for us. I personally truly appreciate our friendship and the fact that you're willing to speak to our audience today. Can't thank you enough, Ryan. It's been great.
You're more than welcome, Andy. I'm always happy to do it. Thanks for having me.
Thanks very, very much. We'll talk soon. So, ladies and gentlemen, thank you for joining us today. If you have a different perspective on any element of today's discussion, either what Marty Daks and I spoke about or Ryan's comments, or if you'd like to know more from any of us, contact me directly at andrew.zezas, Zezas, at CFO Intel with 2Ls.com. Now, at the beginning of our discussion, I mentioned that I'd tell you about two offers. I actually have more than two. First, we get very excited when experienced and innovative CFOs share their insights with us. So if you'd like to join me in an on-camera discussion similar to what you saw today, visit CFOIQ.com, or if you prefer to share your perspectives in CFO Intelligence Magazine or in the CFO IntellStats Index, visit CFO Intel with 2Ls.com. Now, CFO IQ on-camera discussions and CFO Intelligence Magazine stories are available at no cost to you or to your company. We're only looking for really, really great content. Now, secondly, if you're a CFO and you'd like to understand in a 15-minute conversation how your company can secure free rent, annual rent reductions, no-cost renovation allowances, expansion or contraction rights, and more favorable terms in your company's facility leases anywhere in North America, even if those leases won't expire for years, visit realstrat.com and drop me a line. Lastly, if you're a senior finance executive and you're local to New Jersey and you'd like to attend any of our CFO dinner or luncheon discussions, visit CFOintel.com, again with 2Ls, and reserve a seat. CFO Intel events are also available to CFOs at no cost. For any of the above, you can simply reach me at andrew.zezas at CFOintel.com. Thanks so much for joining us today. I want to thank Ryan Severino of BGO. I'd like to thank Marty Daks, editor of the CFO IntellStats Index and CFO Intelligence Magazine. And a big shout out to our producer, Joe Lara, for helping us put together today's event. We hope you'll join us again next quarter. Oh, I'm sorry, and I want to thank you for joining us. So I hope that you'll join us again next quarter. I'm Andrew Zezas, and this has been the CFO IntellStats Index Kickoff and 2026 Economic Outlook. Keep plugging away.